So you've done your due diligence, you've had an offer accepted, and you're ready to purchase the property. But the lender comes back and said the property you're purchasing is worth less than what you've agreed. Unfortunately, down valuations have been more and more common in recent years, but here's why they happen and what you can do if you get a down valuation. If you're new here, my name's James, and this channel is all about helping you grow your knowledge and understanding about property investment without gimmicks or unrealistic promises. I'm the co-founder and managing director of a property investment business called Freighter Property Partners, but this channel is all about your education. As always, don't forget to hit like and subscribe to the channel for all things property investment. So first and foremost, what is a down valuation? A down valuation is essentially where a surveyor comes out to the property in which you're purchasing and says that it's worth less than the agreed price. This isn't personal, but lenders are businesses too. They have to manage their own risk, and this is the way they can do that in the most efficient way. Essentially what happens is when you're in the process of purchasing a property, you apply for your mortgage, the lender sends a surveyor out, they value the property. If it values up, you get your mortgage to what you need it to be, and if it doesn't, then you may have a few hurdles you'll need to jump through in order to get the valuation you're looking for or to look at all your options. So why do down valuations happen? The first is pretty obvious. The lender feels the property is overpriced and they're not willing to lend up to the amount in which you're looking for that specific property. This is when it's compared to local comparisons. If you've done your due diligence and you know that there are properties on the market in the local area with a similar square foot and a similar quality at that valuation, then you should be okay. However, it's not always as straightforward as that. The next reason may just be because the surveyor is unfamiliar with the area. If they've looked online, done a desktop valuation, or they've not been in the area for very long, they may not feel confident on valuing the property at the level in which you're purchasing. The third reason is linked with the first, but it's slightly different, is that there's a lack of comparable evidence on the market. That might mean that this property is a one of a kind, which means demand should be high for this type of property. But if there's no real true comparables in the area, it can be difficult for a surveyor to come out and value that up to the value in which you're doing because they don't really know, because they can't see if there's genuine comparables. This can often happen in areas of regeneration when there's the first development of its kind in that specific area. There's no true comparable evidence, which might mean there can be difficulty when getting mortgages at the start. Having said that, after a couple of years and there's a few other comparables, it should be less of a headache, but you might have missed that opportunity to get in early. So it's about balancing that. The fourth reason is rapid market changes or uncertainty within the property market. This is actually something we've seen a little bit more in recent years due to uncertainty after COVID and everything from that perspective. Some people lost some confidence in the market, which meant that surveyors wanted to be careful. The reason they want to be careful is because unfortunately back in 2008, some surveyors were a little bit too punchy on where they saw the property market going. This meant that when there was a crash in 2008 and lenders lost a significant amount of money, some lenders went and sued a lot of surveyors because they felt that surveyors were too confident or too punchy with their valuations and ultimately opened them up to the risk of the downturn of the market. This might mean that if there is sometimes a lack of comparables or the property that you're investing is a first of its kind, then surveyors are more likely to be a little bit more cautious nowadays than maybe they would have been 10, 15, 20 or even 30 years ago. The final reason a surveyor might downvalue a property is because it's maybe investor-led. Investor-led sites aren't the end of the world. A lot of the time, in areas of regeneration, investor-led sites are the start of this regeneration of the area. This is because investors are often looking for the next best thing, not the best thing right now, which means they're getting into areas where they're still a bit more affordable and they're going to benefit from that appreciation over time. Home buyers are often obviously looking for things that are nice now and they want to live in these areas right now. So if you are looking at a property or a development which is a little bit more investor-led, there's just something you need to be aware of. It's not something to be afraid of, but you need to do your due diligence, you need to feel comfortable, and you need to feel confident that you're going to get the appreciation over the long term. So what are your options if and when you get a down valuation? The first is you can appeal or challenge the valuation of the property. This means that you'll need to make an appeal to the lender and show genuine, true, comparable evidence. The problem with this is although you might feel that there's genuine comparable evidence, it doesn't necessarily mean that the lender is going to change their mind or ignore the surveyor's recommendations. You're essentially asking the surveyor to admit that they got it wrong. And although sometimes they can hold their hands up and admit that they are wrong because they are just human, it is difficult and most challenges or appeals aren't successful. If you have looked at it in more detail and think maybe you have overpaid for the property, what you could do is try and renegotiate the price, but that will all come down to the seller and whether they're comfortable to do that with you. The next option is you could cover the shortfall with your own cash. If the down valuation is only by a few £1,000s, what you could do is put a slightly bigger deposit in, cover that, but you need to make sure that you're confident on the long-term prospects that the property will grow in value because you're putting a little bit more cash. This is probably the most common thing that happens. Sometimes you can try and meet the seller halfway, but essentially if you've done your due diligence and you felt that you were purchasing the property at the right value, sometimes surveyors come out and they've just had a bad day and valued it differently to what you believe. If you're confident, then you can just bridge the gap, put a slightly bigger deposit in and wait for the appreciation to happen over time. Having said that, you could always switch lenders. What you could do is go to your mortgage broker, choose to go with a new lender, reapply, which will cost a little bit more moving forward. But if it means that you get a truer reflection on the value of the property or the value that you've paid, then why not give that a go? You'll often see this with buy-to-lets if someone has a down valuation based on the rental income that the property is going to produce. If you've done your due diligence and you've spoken to a variety of local letting agents and they all say that you should be able to get a similar figure than what you're looking for from a rental perspective, then it might mean that you just go back, you reapply and hope that they'll send a different surveyor out and they'll value the property higher based on that rental valuation. Your final option is essentially to walk away from the property. Down valuations do happen, and if it's a few £1,000s here or there, then that might be okay. But if it's a significant down valuation, I'm talking £20,000, £30,000 down valuation, the chances are the surveyor hasn't got it that far wrong, and it might mean that it's time for you to actually walk away from the opportunity if it's not right for you. Again, this can be frustrating because you might have already spent a few £1,000s on the property or a few £1,000s in legal costs and so on, but a few £1,000s is better than tens of thousands of pounds. So we know why down valuations happen and we know what your options are if and when you do get a down valuation. But how do we as investors reduce the risk of these down valuations happening? The first is obviously do your research. Make sure there's true comparisons in the market. And if you're in a regeneration and it's the first of its kind, you might just need to be aware or be comfortable to put a slightly bigger deposit than the 25% that's usually required. Question the price. Just because someone has told you a property is worth something doesn't necessarily mean it is. Make sure that you've done your own research, feel comfortable before you agree to anything moving forward. You can work with good quality local estate agents or investment agents that understand the local market and understand the local pricing of that specific area. You can try and take some of the emotion out of buying an investment property. When the market's hot and everyone's confident, everyone wants to get a deal. That means people start overpaying for properties and they reduce the opportunity to get a good quality deal. This means that in quieter times, it might actually be a better time for you as an investor to start looking at opportunities because it gives you more opportunity to secure a good deal. Because sellers are essentially more motivated and they have less interest, so you might get a better quality deal. The final thing you need to do is prepare your broker. Make sure you're partnered with a broker who knows what they're doing and understands investment property. If they work in this area a lot, they will have seen it all before and they'll know what to do as and when or if you get a down valuation. Again, as I mentioned earlier, it might be just reapplying to another lender and they should know that that lender uses a different surveyor or a different surveying company to do their valuations. So remember, down valuations are actually quite common in the current market. They're annoying and they're frustrating, but it doesn't necessarily mean it's the end of a deal as long as you know and you're confident you've done enough due diligence. You have got options, so if you follow a process and make sure you do everything right, the chances are you're going to mitigate this risk and reduce the chances of down valuation. And finally, be proactive. You'll either need to know the local market better than that surveyor, or you need to partner with someone that knows the local market. So if you do have any issues, they can push back in the right way and protect your interest at all times. If you've ever had a down valuation and still made the deal work, I'd love to hear from you and hear your stories if we're looking back from a 3 to 5 year perspective to see what has happened in that time. But that is it for today's video. So thanks again for watching and I'll see you in the next one.